My name is Nate Scott. You may have heard me around, whether you've taken our free beginners course or the podcast or some other things, but it is a pleasure to host another one of these webinars with you. I'm really looking forward to this one. Some of you on this webinar may have been on the last one we did, which was just last Thursday, so just a few days ago. If you did attend that one, or if you viewed the recording, that would actually help you in this webinar as well. As we kind of I kind of prefaced this one. And so what we're going to do today is a couple of things. First of all, I just wanted to mention, I do value your time. I value my time. I always like to mention these things. I don't, one of the things I don't really love whenever I'm on webinars is having to be stuck for a long time, just wading through material, trying to figure out when the good stuff's coming. So I don't think we're going to be here anywhere close to a full hour. I like to get into it, so that's what we're going to do. If you have questions, we will open it up at the end for questions. If you do type in questions while I'm going over the material, I probably won't answer them. So if I were you, I would just wait until the end, because I won't be looking at questions while I'm kind of just presenting the ideas here. And then at the end, we'll open it up. So save those for the end. But with that, let's go ahead and dive in. This webinar, this concept that we're going to go over today is based on one of the main questions that we get when it comes to an individual looking to start with infinite banking. And even those who are already doing it, it's also kind of top of mind as well. In fact, Nelson Nash in his book. So for those of you who don't know Nelson Nash, he's the founder, the creator of the infinite banking concept. He wrote the book on it. That's where we get this idea from. The book's called Becoming Your Own Banker. And he mentions in his book, it's actually my favorite discussion in the book. So if you haven't read his book, go get it now. Read it more than once. I've probably read it 30, 40 times. And I feel like I get something new every time I read it. It's one of those things you really can't read just once and get everything out of it. So I like to call it the Bible of banking. I feel like every time I read it, I get something new. But with that being said, in there, it's actually page 69 of his book. He mentions this. He says, most people, when they get introduced to the idea of infinite banking and using these policies as a banking tool, they think about it in a way that they're used to thinking about things, which is as an investment of sorts, as like a saving strategy. And so what they think about it is they'll say things like, well, wouldn't I be able to get a higher rate of return investing in mutual funds, or investing in real estate, or investing in gold and silver, or whatever it is that they are keen on? They're curious, well, what if I get a higher rate of return doing that? Does it make sense to use this policy? And so that's the main question we're going to talk about today, is that whenever we have to change our thinking and change how we perceive certain things in order to do infinite banking the right way. And because infinite banking itself is a concept, it is a way of using these life insurance policies as a bank, not as an investment. And so we're going to show you exactly how to answer that question. Essentially, what we're going to do is show you how you can use a policy to make an investment and actually end up earning more money than if you hadn't had the policy to begin with. So, and we're going to discuss that here to start with, and then I'm going to show you a real life example with a policy that's being used to make an investment, and show you and give you some pointers on how to do it properly, how to think about it, and show you, with a real life policy that it's possible to make a lot more money, because it's always better to have two assets that are growing instead of just one. So that's the main question we hope to answer today, is that you really can never make a higher rate of return outside of owning the banking element, because all of us are going to deal with banking in one sense or another. Wealth has to reside somewhere, and it's got to move. And just like we don't really see our checking account as an investment, it's simply a short-term storehouse or tank that we're going to be using. Money flows in, money flows out. That's the same concept that we need to bring into infinite banking, that money is flowing in, money is flowing out. The fact of the matter is, we're just going to change who's making all the money off that flow instead of it just being a checking account earning nothing for you. The policy itself, as an owner of that policy and an owner of the mutual life insurance company where you're holding that policy at, you're going to make a lot more profit than if you just use banking the normal way. So let's go ahead and dive in. I'm gonna jump onto the screen here. I got a whiteboard pulled up. I'm going to share conceptually how this works, some tax advantages that you can get through investing with the policy, and then we're going to dive into a real life example of what's going on. So fairly simply to start with, whenever you're going to invest money in some form of investment, the flow is pretty simple. We're going to say here that most people are dealing with a checking account as kind of their financial hub, for better for worse. And that's where we're going to build up some money that we're going to use to make an investment. Now, I really don't care how much money you have to invest, but I'm going to go ahead and say that you have built up $100,000 in this checking account. I don't care if it's 1,000, 10,000, or anywhere in between. It just makes it real easy to do math with a nice big round number like that. This is how my brain works. So we've got some money built up in a checking account. You want to go make an investment. So all we're going to do, remember, there's one movement in how we normally just make investment before infinite banking was introduced. This is just how we normally would do it. We go out, we find an investment, a place to store the money, a place to move the money into that's going to generate some type of return for us. We hope it's a great, a great return. So we move this money into an investment. And for our illustration, I'm just going to assume that that investment produces a 20% rate of return. It could be high, that could be low, but we're just going to assume this, today that it could earn any amount, but we're just going to call it 20% rate of return. So that means that as this investment produces profit, whether that's a cash flow profit, in other words, if it's like a cash flowing investment where it's spitting out money every year, or whether it's kind of a buy and flip style thing, whether you jump into the stock market for a brief moment and then hop out, or own a property for a brief stint and hop out. Either way, we're going to assume it's going to make a 20% rate of return. So a 20% rate of return on $100,000 is $20,000, correct? $20,000. So what happens is this investment produces a profit. That profit, 20% rate of return, let's say, is $20,000. And that money just finds itself back in the checking account, and we may redeploy it again and so forth, as we normally would. But the problem with this scenario is that we forgot about your partner in this investment. And here in the United States, we've got a friend named Uncle Sam, who's a partner in all of our investments. And he says, you know what? Well, if you're going to make a profit here, if you're going to make $20,000 of profit, you need to pay your fair share to me to build roads and fund the military and all sorts of different things that we like to do. So let's just assume this $20,000 profit is not all yours, because we have the IRS to deal with. And so if you're in the 30% tax bracket, then you're not going to receive $20,000 in your checking account at the end of the day. We're going to have to send some of that money to the IRS. So 30% taxes on $20,000 of profit, of income, is $6,000 that we owe to the tax man. So 20,000 minus 6,000 of taxes really means that this investment is going to end up producing for us $14,000 of profit. So essentially how this works is we've got 20,000 of profit from this investment that we made, but we've got $6,000 to the tax man for our 30% tax bracket. We're left with $14,000 of net profit, net income on this. And we're doing pretty good. That's an after-tax rate of return of 14%. We're feeling pretty good. And that's pretty basic. That's just what we're all used to. All that infinite banking does is it adds one more bubble to this equation. The rest all works the same, but I'll show you how we can actually make more money with a policy in the mix instead of just building up money in a checking account. So if I go down here, all I'm going to do is essentially add one more bubble to this, one more entity to this, this plan. Instead of building up money in a checking account to take advantage of opportunities, or a savings account or a CD or something like that, something more typical at a bank, what we're going to do is build up $100,000, not in a checking account, but in a policy. over a few years, assuming it took a few years probably to do both the checking account and the policy. And so whenever we're ready to make the same investment, we're going to pull out our $100,000. We're going to put it into the same checking account that this guy had up above, putting it into a checking account. And then from there, we're going to write a check and make an investment. So the checking account and the investment are really doing the same thing. The only thing we've changed is where did we build up the money to take advantage of this investment? That's what we've changed so far. We're also just going to assume that the investment is the same investment. So just like it produced a 20% rate of return up above, we're going to assume it's the same thing. You and I each buy into the same investment. It produces 20% profit. Well, 20% of $100,000 is a $20,000 profit. So once again, that investment is going to spit out $20,000 to our checking account. The only difference here is that where we got the money really comes into play in this scenario. Up above, there was no policy. So we just looked at the profit. We paid taxes on it. We got left with 14. We felt pretty good. But here, we actually owe the policy loan interest on this money. So instead of us just having a $20,000 profit, what essentially happens is at the end of the year, the policy is going to require 5% interest, let's just say, back on this policy loan that we use to fund our investment. And if you guys, if I have some investors on this call, if I don't, I'm going to try to teach you something. Try not to be too overwhelmed with what I'm about to say. But essentially, let me back up and not even assume we have a policy and just kind of remind some people of how taxes really work. So if you were to go out and make an investment and borrow money to make the investment, the interest that you pay is actually an expense or a deduction against any profit received from an investment. So if you were to go out and buy a rental property or even a fix and flip property or something like that, and you get a loan from the bank to fund that investment, any interest that you pay back to the bank for the loan to buy that piece of property, that is an expense to you on your tax return. Now, if you bought, it's also an expense for your primary residence, but there's a lot of things like if you go buy a car personally, yeah, you may pay interest, but a personal car isn't an investment. It isn't a business purchase. It's just a personal car. You don't get to expense that. But if you're if you're borrowing money in a business setting or for an investment setting, any interest you pay on that loan to purchase a property, let's say, would be an expense. The same thing would go if you're buying stocks on margin. If you've ever heard of a margin account, where you're using your stocks as collateral to get a loan to buy more stocks. Any interest that you pay on that margin account is an expense. Same thing would go for hard money loans to flip a property. So essentially, what I'm trying to get at here is that we did make the same profit on paper up to this point. However, we did borrow the money from the insurance company in order to make this investment. So at the end of the year, we actually have to send $5,000. That's the 5% interest on a policy loan of a $100,000 policy loan. We actually have to send $5,000 to the insurance company. And if we use a policy loan to make an investment, that interest is counted just like any other loan interest to make an investment. So we are now able to deduct $5,000 off of our taxes. So instead of paying taxes on $20,000, we're only going to end up paying taxes on $15,000. So let me show you how this plays out really quick. Assuming we have $20,000 of profit, just like we did above, this time before we calculate our tax, we have to pay $5,000 of interest back to the policy. So that leaves $15,000 as our taxable income. And if I do 30% tax rate, same tax rate of $15,000, that actually is $4,500. 30% of $15,000 is $4,500. So I have to take out $4,500 still. I still owe some tax. So I got to take out $4,500 for the tax man. Can't get that all the way to zero. And at the end of the time frame, we are left with $10,500 in the checking account. So we had to use our checking account to pay tax of $4,500, and we had to use our checking account to pay interest of $5,000. So whereas above we had $14,000 in our checking account, we only have $10,500 in our checking account here. So Nate, why on earth are you saying to me that it's better to use a policy to make an investment? Isn't 14,000 greater than 10,500? Well, yes, it is. It is. But remember, the policy is the new bank. And when we took out this $100,000 loan against our cash value, what was happening to that cash value the whole time that we had this money loaned out? What was happening to it? 100% of that cash value, the $100,000 in the policy, was continuing to grow and compound on the full amount. Remember, guys, a policy loan from one of these policies is not a withdrawal of money. It uses the cash value as collateral to take out a loan, which allows our cash values to continue to grow uninterrupted on the full amount. So if you've built up $100,000 of cash value in a policy or any significant amount like that, the policy is going to continue to grow probably by $4,000 to $5,000 a year. So we say, just approximate that the cash value increase was $5,000 on $100,000 of cash value, which is fairly typical for a lot of policies that are capitalized like that. You now don't have just $10,500 of in your checking account as the only money that's available to you. You also have $5,000 inside the policy cash value from the growth of the policy. So now you're actually sitting between the money that's now available in your checking account, $10,500, and the interest and dividends that grew in your policy cash value, which increased from $100,000 to $105,000. You now have a total access to money of $15,500 net after we take into account how much money built up in our policy alongside how much money we still have sitting inside the checking account from the profit of the investment. That certainly is a higher return than what we were able to receive from just making the investment out of pocket. Though where most people get hung up on in this whole scenario, and the biggest problem that we see that is mainly just a problem of our perspective, is that very few of us, until we get in deep into this for a few years, we very rarely see the policy as a bank. What we see it as is, in other words, I've been talking to clients, and this happens all the time for individuals, where we don't like it when money leaves our checking account. And so whenever we're talking about paying premiums or paying loans back or paying loan interest, people think it's going to be bad because I'm suggesting they take money from a checking account to put it into a policy. But the problem is that we're still stuck seeing the checking account as the hub, not the policy. If you want to practice infinite banking properly, we have to change our perspective where the policy is the hub and the checking account is just an extension of the policy. So in the real world, I wouldn't suggest leaving $10,500 in the checking account. I would suggest rolling it all back into the policy and making the policy grow faster. And that's kind of what I'm going to show you to do, how to do that in just a moment as well. But remember, one of the big missing pieces is you have to start seeing the policy, the cash that's in a policy, as just as valuable as the cash that you have in a checking account. In fact, I would like to have you start seeing it as more valuable. That's where we would want the money to be. So this was theoretically how it worked. I want to show you how honestly it can be even a little bit better when we look at a real policy and show you a real example. So I'm going to pull that up here on this slide. And I think I may have done this before. So some of you, if you've been really staying in touch with our webinars, maybe you've actually already seen something just like this before, which would be great. And I had to decide, for the sake of time, what kind of investment I was going to show being done through a policy loan. And it does happen to be the most common by far investment that we see being used from policies is rental real estate. Cash flowing real estate is very common, by far the most common form, or maybe other types of cash flowing investments. If you talk to Ray, our founder, he's really big on lending money. So it's a form of cash flow. It's getting consistent payments back. But it doesn't have to be cash flowing. It can be more of what we would call an appreciation investment, where it's not spitting out cash flow every year, but it's growing in value, and we're going to sell it sometime later for more than we put in. It works well for that too, but it certainly feels like a perfect marriage when it's using a policy to make an investment in something that's producing cash flow. So that's what we're going to do here. We're going to do this one example. I've simplified it so we can really grasp it. Obviously, real life can get a little bit more hairy and maybe even a bit more fun. But just for the ease of example, we're going to look at it pretty simply, just making one investment. So let's go ahead and present the stage here of what's going on. In this example, we've got a 40-year-old individual who starts a policy, and he's going to fund it $15,000 a year for 5 years to build up this policy. And after 5 years, you'll notice we stop making premiums. We stop paying out-of-pocket premiums on this policy. There is a reason I am showing us stopping paying these premiums. I think some people look at this and they see other examples and they're really excited for when they don't have to fund premiums anymore. And I want to put a word of warning out there. I'm not showing the premium stopping because it's a suggestion. What most of the time when people want to stop paying premiums, what the problem is they're seeing the premium once again as a payment, and that's taking money out of my checking account, and I don't like to see that, instead of seeing the policy as the new checking account of sorts. So just keep that in mind. I'm not suggesting that you should stop funding your policy. That would be foolish. In 9 out of 10 cases, it would be very foolish to do so, because you're going to get so much more growth if you continue to fund it out of pocket. The reason that you'll see examples like this where we stop paying the premium is simply because we want to isolate what we're doing with the policy to show you that banking, borrowing and repaying from our policy, really produces a profit for you. If I had continued paying in a premium of any amount in this example, the cash value of our policy would certainly accelerate much faster than what you'll see here, because we're adding in a lot of money. So it would be accelerating much faster, compounding on a much higher basis because we're adding all this new money into it. But it would be very difficult to distinguish, hey, did me making an investment with this money, did I actually make a profit from it or not? It would be very difficult to see that happening if we had so much money built up in this policy because we kept funding premiums. So remember that, guys. As you're doing this, we're not suggesting to stop paying premiums. When you see these things happen like this, what we're doing is we're trying to use it as a teaching tool to show you that you can actually make money from the banking system, from practicing it. But I mean, deep down, maybe it's a little bit comforting to know that once a policy is capitalized, usually around year 5 to 7 or something like that of owning a policy, it really doesn't need your out-of-pocket premium contributions if you've built up enough cash value in it. It doesn't exactly need that to keep going. It doesn't, as you can see here. But we still would encourage you to see the policy as a bank, not as a payment that I got to make. We got to get rid of that idea. So either way, that's how we're building this policy up. And at year 5, I have $68,000 of cash value in my policy. You see that PFF account up there? That stands for Private Family Financing Account. That's kind of the system we teach, is private family financing and how to do that. So we've got $68,000 built up in this policy at year 5. And to keep math pretty simple, we're going to go ahead and share how to use this money to make an investment in real estate, buying a rental property. So what we show here is we're going to pull out a loan, a policy loan for $50,000. And we're going to say that's a down payment on an investment property. We could take this $50,000 and do any type of investment that you'd like to do. It doesn't matter what kind of investment it is, but it is going to, it can be anything you want. Remember, this is just an example, not meant to show, you got to use it for real estate. You can use it for many things. But we're going to go ahead and say it's a real estate property. And in that example, I talked to a lot of real estate investors, and many people said they're trying to make about a 10 to 12% cash flow rate of return on their investment. So, on a $50,000 down payment would probably buy a house, $200,000 to $250,000 house. And what they're hoping to do is get, sometimes they'll get like a different kind of loan, or put even less down and get a larger house, or maybe like a duplex or something like that. But their goal would be to have that $50,000 investment produce $5,000-$6,000 a year in cash flow profit. So that's how much money they would expect to make above and beyond paying for the mortgage and insurance and property tax and vacancies and different things like that. So what I did is I cut it down a little bit, and I just assumed, hey, what if we kind of used our benchmark? Let's say this is producing a 9% cash flow. In other words, I put in $50,000 into this property, and it's going to spit out 9% of my investment as a cash flow return. So that would be $4,500 a year that it would be spitting out. This could be $3,000, this could be $6,000. It really doesn't matter. We just had to use a number. So that's what we are going to assume. We just made a $50,000 down payment. Maybe we bought two $100,000 properties, and we needed $20,000, $25,000 down on each of them. Let's just say something like that. Either way, and of this investment, it's going to spit out a cash flow of $4,500. Remember, we built up the money to make this investment from a policy. We didn't do it the old way of building up money in a savings account or a checking account to start making these investments. We built it up in a policy. So that is the bank. That is our new bank. So what are we going to do? We're not going to have the property cash flow come back and just sit idly in a bank account waiting to go do something else. We're going to roll it back into the policy. So that's what you see. We're just taking the cash flow from a property, and we're going to pay it back into the policy to pay back the policy loan with interest and things like that. And we did this for 20 years. We assumed that this person held on to this property for 20 years, and then maybe we sold it or sold it and bought a different property, but just kind of wanted to have an end of, a benchmark of sorts for how long we were going to hold it. Could have been any amount of time, really. But we did choose 20 years down the road for when we, have paid back the policy loan and are no longer going to be calculating, information from it. And so what we've done is over 20 years, all we've done is had the investment produce cash flow. And instead of leaving it in a checking account, we're putting it back in the policy. And I'm going to share with you a couple of things and then jump back into it. But over this time frame, a couple numbers I really want to point out. Let me erase a couple things here just to kind of clear out the board. The year that we took the policy loan from our account, we had $23,000 of net cash value. Some people are confused about how these numbers work. I'm afraid I'm going to confuse people even more. I'm not trying to. But when they see our examples and they hear me say things like, well, the policy is going to continue growing on the full cash value, but then they'll see numbers on here like when we took out this loan and our cash value dropped, and they're like, then why did the cash value drop? Well, it's because there's two things at play. I'm not going to get too much into detail, but your gross cash value, that's how much total cash value you have, is what you're earning money on. But when you take a loan out, you can't just keep borrowing the same money over and over again infinitely. Obviously, if you took out a policy loan, that's going to lower your access to money. So in other words, if we had 68,000 and we took a $50,000 policy loan, we can't just go out and take another $50,000 policy loan and another $50,000 and another 50, even though the cash value is still 68,000, our access to money has decreased. So the net cash value the year that we actually took out the loan was 23,000. That's essentially how you come to net cash value is you take the gross cash value, you subtract your loan balance, and then you have your net cash value. That's how much of it is available to you. So that's a key number. This is kind of our baseline. So when we took out the policy loan, we had 23,000 left, and we go down 20 years, and our cash value has grown from 23,000 to $184,000. To go from 23 to 184, I could probably do that math in my head, but I don't want to make a fool of myself. So I'm going to take 184,000, just round it off, and I'm going to subtract out 23,000, just give us a ballpark. What this says is that it's increased $161,000 from the day we took out a policy loan until when we were finished with this rental property. Now, we haven't been paying premiums on this policy, but we have been contributing $4,500 a year to repay this loan. That was money that this property was spinning out for us on a cash flowing basis, as the owner of that property, having it rented out well. So if I go do another calculation, I'm going to take the $4,500 a year that we put back into the policy and multiply it by the 20 years that we had the money out. So that's $90,000. So I take this and I've got $90,000 here. So if I was just making the investment myself, it produced $90,000 of cash flow over 20 years. That's not bad. But instead of just having 90,000 sitting in my bank account, I actually have 161,000, which means that I made a profit of $71,000 above and beyond what I would have made if I had just used a bank account, used the typical way to make an investment. I made an additional $71,000 without taking any additional risk, without even owing any taxes on that $71,000, just by changing where I built up the money to make this investment, and then what bank, I'm using quotation marks here in my room, but you can't see me, what bank I put the money back into, whether it was somebody else's bank or whether it was my own banking policy. Now, so that's a huge amount. I haven't even gotten into the taxes that we talked about at the very beginning of this webinar. So remember, when you borrow money to make an investment, the interest you pay on that loan is an expense. It's a deduction. So you can figure out how much interest we paid as a ballpark by comparing how much we put into the investment and how much we repaid the investment. So if I invested $50,000 and I paid back to my policy $90,000, that means I repaid $40,000 of interest to the policy. Now that's a ballpark number because $4,500 is kind of rounded up. We paid a little bit of what, if you've been around infinite banking for very long, you'll know that when we take loans out, many times we'll pay extra interest to the policy. And so there's a little bit of extra interest. You'll actually notice that the policy loan rate is 5%, but we're actually running it at 6.58%. So we're paying a little bit of extra interest. So the extra interest that you're paying back to the policy is not a tax deduction. Otherwise, you could charge yourself whatever rate you wanted to and pay back 50% interest and, wipe out all your income. That'd be awesome, but unfortunately we can't do it. So just the 5% portion would be a deduction. But assuming that that in a perfect world, we put back in 90 and we borrowed out 50, that would be $40,000 of interest that we would have paid, or somewhere close to that. Let's say $35,000 in our example here of actual policy loan interest. That would all be a deduction. And it would reduce your taxes every year that you had this investment. So not only do we have $71,000 more than we otherwise would have had, but we also would have had tax savings. If it was 35,000 and you're saving 30% in tax, I mean, that's about $11,000 extra in tax savings over that time frame. Now, some people would also say, well, Nate, if I was making an investment from cash, I wouldn't just be leaving the cash sitting in a checking account. I'd go make other investments. Yeah, we are all for that. That's the whole point of this message. Remember, what do you think would have happened to all these numbers if we built it, if we're looking at this cash value column here? If every time we had $50,000 built back up, we went out and made new investments, what do you think would happen to all the numbers inside this example? They keep going up. So, a few years later, after we made the first investment, you'll know our cash value is back up over 50,000. What if we did the same thing again? And then a few years later, it's back up at another 50,000 has been gained in the policy. What if we went out and made another investment? And a few years later, we got another 50. We made an investment. In other words, we certainly could go out and continue to make investments. In fact, we would encourage that, and that we could actually make these numbers grow even faster by doing so. In the meantime, so we're not exactly just saying, just one investment and then never touch the money again. That would be foolish. One other thing to note is just really what's going on inside here. Like if we take a look, even at any year, just the year after we took out the policy loan itself, you'll notice we had, $28,000 the year after. And the next year it grew from $28,000 to $34,000. That's almost $5,500, give or take. A little bit, $5,500 that this policy grew by that year. How much money did we put into the policy that year? We put in $4,500. So we made almost $1,000 in just one of these early years, tax-free, just by changing where we're building up the money to make this happen. And so, it's not, we don't have to wait a long time. It's amazing to see that, as I had mentioned, a lot of people see their checking account as the hub. We like to have large checking account balances, savings account balances at the bank. It makes us feel good, but we have to start seeing the policy as that new hub and as the source of money. In other words, some people say, well, Nate, if I'm paying $4,500 back to the policy, that was all the profit I made. And then it feels like I didn't make any profit. Once again, guys, we can't let the nickel hide the dime. The cash in your policy is just as valuable as the cash in your banking account. All we did was move money. We took $4,500, we moved it out of a checking account, and we put it in a policy, which increased our policy by $5,500, which means we actually made money by moving it. That's what we're trying to do. So I encourage you not try to overcomplicate it, but the easiest way to overcomplicate it is to see anything that leaves your checking account as bad. That's honestly the trap that most people fall in. And even Ray, Ray Poteet, our founder, for those of you who know him, he has mentioned many times, whether it's on our podcast or something else, times where he's had these big premium payments come due for his policies. And I've had this same feeling before in my own life. It's just becoming more rare and rare. And I don't have quite as many premiums as he does. So it's not a total fair comparison. But he's mentioned times where, a big premium month, he's like, man, this is going to keep me really tight. And he'll stress about it for a moment, and then he'll remember. There's one time he had about $100,000 of premium due in 1 month. He's got a decent amount of policies, guys. And he was kind of fretting about how to get the money and how to make it work. And then he kind of got the aha moment, or the reminder, the epiphany of, wait a minute, what's going to happen in my policy when I send this $100,000 check? And so he asked our policy service team, hey, can you guys call the insurance company and see how much money is my policy going to grow by this year? And so he put in $100,000, and they hear a word back, your policy is going to grow this year by $120,000. It's like, oh, okay, no big deal. I just moved $100,000 in. I've got $120,000 that I can get back out. Things are doing pretty well. And so that's really what we're trying to say is once you get these policies rolling, we have to stop seeing them as a payment or an obligation and more as a real banking tool where we want the money to go there. I get excited to pay my premiums because I know that that is an exchange of money. That's a transfer of money out of somebody else's bank where I don't want it into my own bank where I do want it. So that can really help you as you're seeing this. So remember, this is kind of a side-by-side comparison. We're not opposed to investing money. The reason why you don't see us very often compare infinite banking to mutual fund or infinite banking to real estate or certain things like that is because we actually want you to be creative and seek out opportunities and take advantage of them in these other investments. Talk to Ray, my mentor, how much money, millions and millions of dollars he has invested in his own lending business, all funded from policies. We are not opposed to investing money. All we're trying to do is show you a way to use a policy as the new hub, as the new tool, and you'll actually make more money by doing it this way than doing it the old way. And so many people say, well, Nate, what's the rate of return of a policy? Well, I don't know. I mean, what do we compare to what? Can I show you if I say it's 4.5% and you say, well, Nate, I can make 8% doing this. I say, great. Can I show you how to get both going together and make a lot more money? So this is what you can see when you have two assets growing at the same time, uninterrupted compounding, and how powerful that can be. So it really was a pleasure, being able to be here today. I'm about to open it up to questions, but before I do, just wanted to let you know, if you do have some in-depth questions, which maybe I think I've seen a lot of people in the chat bar and a few of the other question and answers that I remember I kind of mentioned at the beginning for those of you who weren't there. I wasn't going to answer questions until the very end. So if you typed them in, I don't know if I'm going to get to them, but I will make a message to in the chat bar that you can go in. If you would like to speak with me more in depth, you can go to www.livingwealth.com/meeting, livingwealth.com/meeting, www.livingwealth.com. If you'd like to, you can schedule a time to speak with me or one of our other colleagues, and then you'll be able to kind of see maybe more in depth for what you would like. So livingwealth.com/meeting. Feel free to book a time with me. I'd be excited to talk to you more about this, especially if you have some ideas to go over. But with that being said, I am going to open it up to some questions. So I got one question. Does policy have to report the interest payments received as income, being that those payments are being written off? Well, your policy grows tax-free. So it doesn't matter if you have a loan or not. You're never going to get a 1099 from the insurance company. I think if you want to go in depth into that question, is the insurance company itself a nonprofit organization? The answer is no. So who is receiving the $5,000 of interest we pay to the insurance company? It is the insurance company. And the insurance company is an entity that does pay taxes, but your policy itself, as it's growing, does not pay taxes. We got one question. Is age 65 too old to start this? The answer is no. I mean, we've got individuals in their 90s who get started. Sometimes it makes sense to start on your own life. Sometimes it makes sense to start on a child or a grandchild or someone else, depending on health factors and other things that do occur as we get older. But age 65 is by far not too old to make this happen. Will there be a replay link? Yes. If you registered, then you will be able to view a replay. View a replay link. I think I've got a couple maybe in the chat bar. How is that interest deductible? So interest on policy loans is tax deductible. No, interest on policy loans is not tax deductible unless it's used for business or investment purpose. So for more on that, you'd want to kind of look into the tax law a little bit to figure that out. But remember, guys, it doesn't, you borrow money from your policy to buy a car, that interest is not tax deductible. You borrow money from your policy to make an investment, that interest is tax. Remember, the use of the money is the most important when it comes to tax deduction. Same thing goes in anything. If you borrow money to buy a stock, it's deductible from a bank. You can write off. So the purpose of the policy is very important. What tax form do you get for the interest paid on a policy loan? You do not get a tax form for interest paid on a policy loan because interest itself it's not like a mortgage interest where you get like a 1098 mortgage interest statement every year from your bank for paying mortgage interest. In a policy loan, they don't know what you used it for. They have no idea if the interest is tax deductible. So they don't send out 1098s or anything like that. But you do get an interest statement every year from your policy loan along with your policy anniversary statement. And so the interest that is on that statement is what you can give to your accountant as a write-off if you used the policy loan to make an investment. If you have policy loans that are for personal use and policy loans that are for business use or investment use, then you're going to have to do your own math to determine, okay, if I've got $60,000 borrowed out and $20,000 was for personal and $40,000 was for business, then I can only write off the interest attached to $40,000 of this tax bill. So, I mean, there can be some difficulties there. Sometimes we suggest people have one policy that's more designated for personal use and another one for more investment or business use. Sometimes that makes it easier. So great questions. All right. Well, it looks like we are out of questions now. If you do have any other questions, you can always reach out to me. I'm happy to answer those questions. But with that, we will go ahead and close it out for today. It's been a pleasure, as always, to be with you. Thank you so much for taking time out of your day to come to this. We do appreciate you. Here in the COVID-19 world with the stock market dropping, maybe there will be opportunities for us who have cash value to take advantage of investments on sale. So just keep your eye out. God bless you, and we'll talk to you soon. Thank you.